In 2021, a 19-year-old college student bought a cryptocurrency called Dogecoin for 5 cents and sold it for 45 cents. He made $100,000 in just 3 weeks. A 55-year-old dentist saw this, bought the same coin for 60 cents, and lost his children's college savings when the price crashed to 8 cents. You might think the student was a genius and the dentist was a fool, but that is wrong. Both people were making choices that made sense, but they were playing two completely different games. The biggest mistake you can make in money is playing someone else's game without realizing it. This is chapter 16 of The Psychology of Money, You and Me. This chapter explains a problem that most people don't see. A problem that causes more bad investment decisions than being greedy, scared, or ignorance. The problem is that even though everyone is in the stock market together, they are not all playing the same game. A day trader who buys Tesla stock at 9 a.m. and sells it at 2 p.m. is playing a completely different game than a 35-year-old saving for retirement. The day trader doesn't care if Tesla will be a successful company in 10 years. They only care if the price is moving up right now. Even if the stock is way too expensive, they don't mind. They aren't planning to own it long enough for the actual value of the company to matter. The retirement investor is the opposite. They don't care what the price does today. They only care if Tesla is a strong, healthy business that will grow over the next 20 years. If the price goes up or down by 10% today, it doesn't change their game at all. Both people are making smart choices, but only for their own game. The problem starts when the retirement investor watches the day trader buying Tesla stock for $300 and thinks, if they are buying it, it must be a good investment for me too. But the day trader only wants to keep the stock for 4 hours. The retirement investor wants to keep it for 20 years. Their goals are completely different. Copying someone who is playing a different game than you is one of the fastest ways to lose your money. The lesson is simple but very important. Before you do anything with your money, you must know what game you are playing. Most importantly, you must make sure you aren't accidentally playing a game that belongs to someone else. Let's look at our first story, the dot-com bubble. The best example of this in financial history is the dot-com bubble of the late 1990s. Between 1995 and 2000, the prices of internet company stocks went crazy. Companies that made no money, had no profits, and sometimes didn't even have a real product were suddenly worth billions of dollars. Companies like Pets.com or eToys saw their stock prices double or triple in just a few weeks. And here's the game confusion that Morgan highlights. Short-term traders were buying these expensive stocks, and for their game, it actually made sense. They knew the companies weren't worth that much money, but they didn't care. Their goal was simply to buy a stock at $50 and sell it for $80 the next week. To them, it didn't matter if the business was good or bad. All that mattered was that the price was moving up. Many of these traders made a lot of money very quickly. Long-term investors, like regular people saving for their retirement, saw these traders making a lot of money. They saw the prices going up and heard how excited everyone was. And they thought, I should buy these stocks too. Everyone else is getting rich. The problem was that they were playing a different game. They weren't planning to sell the stock the next week. They were buying it to keep for 10, 20, or 30 years. When you plan to hold a stock for that long, whether the company is actually a good, healthy business matters a lot. When the bubble burst in 2000, the short-term traders were mostly already out. They had taken their profits and moved on to the next thing. That was how their game worked. But the long-term investors were still holding their stocks. Stocks of companies like Pets.com and Webvan went to zero. Over the next 2 years, the stock market lost almost 78% of its value. Trillions of dollars vanished, and most of that money belonged to regular people who had confused someone else's game for their own. These people didn't lose money because they were not smart. They lost money because they copied what other people were doing without realizing those people were playing a completely different game. By the time they figured it out, it was too late. Let's look at our second story, the housing bubble, same mistake, different asset. The same thing happened with housing before the big crash in 2008. In the early 2000s, house flippers were buying homes, keeping them for only 6 months, and selling them for a 30% or 40% profit. They were playing a short-term speculation game. In that game, it didn't matter if house prices were way too high, because they weren't planning to keep the houses long enough to care. Regular families saw these house prices rising and saw the flippers making quick money. They thought, we should buy too. We should buy the biggest house we can afford because prices only go up. But these families were not flippers. They were buying homes to live in for 30 years with 30-year loans. Their game was completely different. When house prices finally crashed, the flippers took some losses, but many had already exited. The families, however, were stuck. They owed the bank more money than their houses were worth. They couldn't sell their homes, and many of them lost their houses to the bank. Different games, same table. Catastrophic result. This is more important today than ever before. We just lived through the biggest game confusion event in a generation. The 2020 to 2022 crypto and meme stock chaos, where millions playing the wrong game. Between 2020 and 2022, something unprecedented happened. Millions of new first-time investors suddenly entered the market through apps like Robinhood in the US, eToro in Europe, and Trading 212 in the UK. These new investors entered a market where many different games were being played simultaneously. Even though everyone was buying the same stocks and digital coins, they all had completely different goals. Let me map out all the games. In Game 1, institutional traders, hedge funds and banks uses algorithms and massive data sets to trade in milliseconds. Holding periods are seconds to hours. Their game is to exploit tiny price inefficiencies at high speed. In Game 2, crypto insiders and venture capitalists buys tokens early, sometimes before public launch, and sells after the hype drove prices up. Their game is information advantage and early access. In Game 3, social media influencers buys assets and promote them to millions of followers, and selling into the demand they created. Their game is audience monetization. In Game 4, regular people, the first-time investors who puts their savings into crypto, meme stocks, and NFTs. Their game is building long-term wealth, but the assets they were buying were priced for Games 1, 2, and 3. And this is where the disaster started. Regular people saw Bitcoin's price jump from $10,000 to $60,000 and thought, this is a great long-term investment. But that $60,000 price was created by short-term traders and big investors playing Game 1 and Game 2. That high price was part of their fast game. It wasn't based on a safe 20-year retirement plan. The same thing happened with NFTs. Regular people saw an influencer buy a Bored Ape NFT for $200,000 and thought, these must be valuable forever. But the influencer was playing Game 3. They planned to sell it as soon as they finished promoting it. That $200,000 price was about getting attention, not about the actual value of the art. When the music stopped in 2022, the crash was huge. Bitcoin dropped from $69,000 to $16,000. NFTs lost almost all of their trading volume. By the time this happened, the people playing Games 1, 2, and 3 had mostly already sold their shares and moved on with their profits. The regular people were left holding stocks and coins at prices that only made sense for someone else's game. A 2023 report from the Bank for International Settlements studied 95 different countries. They found that most regular people who started buying crypto between 2020 and 2022 lost money. These were not stupid people. They were smart and hardworking. They just made one big mistake. They assumed everyone in the market was playing the same game as them. They looked at high prices and thought it was a sign to buy for the long term, not realizing those prices were just part of a short-term gamble for others. Morgan wrote about this in 2020 before it all happened. He predicted it perfectly. This is because game confusion isn't new. It happens with every bubble and every new generation. The names of the stocks and coins change, but the mistake stays the same. I'll be honest, I've fallen into this trap badly. In 2021, I bought a cryptocurrency, not because I had researched it, not because it fit my long-term investment plan, but because everyone around me was buying it. My WhatsApp groups were full of screenshots of profits. Twitter was celebrating a new all-time high every week. Influencers were calling it the future of finance. I bought it right when the price was at its highest. Within 6 months, I had lost 70% of my money. Looking back, my mistake is easy to see. I am a long-term investor, but I made a choice based on signals from short-term traders and promoters who were playing a completely different game. Their excitement and their price goals weren't meant for me. They were playing their game, not mine. Since reading this chapter, I've developed a simple rule. Before any investment, I ask, whose game set this price? If the price was set by day traders and speculators, I treat it with extreme caution. If the price was set by long-term fundamental analysis, it aligns with my game. This rule isn't perfect, but it has stopped me from making many bad decisions. That alone is worth more than the money I lost in 2021. Know your game. Ignore everything else. There are 3 takeaways from this chapter. First, when you see someone buying a stock enthusiastically, ask yourself, what game are they playing? Are they a day trader, a hedge fund, an influencer with a financial incentive to promote this asset? If they're playing a different game than you, their buy or sell decision is irrelevant to your strategy. It's not a signal, it's noise from a different game. Second, be suspicious of influencers' advice. Ask yourself, if nobody on social media was talking about this stock, if no influencer was promoting this crypto, if no colleague was bragging about this investment, would you still buy it? If the answer is no, then you're not making an investment decision. You're being pulled into someone else's game. Third, ask yourself, are you investing for the next 5 hours, 5 months, 5 years, 50 years? The answer to this question changes everything about what's a good investment. If your time horizon is 20 plus years, then today's price barely matters. What matters is the long-term quality of the asset. But if your time horizon is 2 days, today's price is the only thing that matters. Know your horizon. That's chapter 16, You and Me. This chapter reveals the reason behind most bad investment decisions, copying someone who was never playing the same game as you. In the next video, we cover chapter 17, The Seduction of Pessimism. And this one is fascinating. Morgan explains why pessimism sounds smarter than optimism, why the person predicting a crash always sounds more intelligent than the person predicting growth, and why this cognitive bias causes people to miss out on the greatest wealth-building opportunities of their lifetimes. Like this video if it made you realize you've been playing someone else's game. Subscribe and tell me in the comments what's your game. Write it down right now. Committing to your game publicly might be the most valuable thing you do today. See you in the next one.